So this is part 3 of banking crises and all that stuff, where we actually talk about bank runs now. So finally, we get to bank runs, which gets us one step closer to Silicon Valley Bank. So, what are we going to do in this lecture? Well, first we're going to learn very simply about what a bank does. And I'm sure, like everybody here, everybody in this class already knows what a bank does. But you know what the hell? Let's go over it one more time just to make sure we're all on the same page in terms of the bank's operations and how it's going to be relating to the issue surrounding bank runs. Then we're going to be talking about what bank runs are and what causes them, and then some of the implications around bank runs. And we're going to do so via a model of bank runs to try to explain where they come from and why. And then next week, we'll finally get on Silicon Valley Bank. So, what does a bank do? Well, the bank takes deposits from depositors, right? So you get paid, you go to the bank, you deposit your money in the bank. Under fractional reserve banking, they take the deposits, they hold on to some, and then they're going to play around with the rest. And they're required to hold some fraction of those deposits. Those are required reserves. We talked about those very early in this semester. And they're held in the event somebody comes in and says, hey, I want to close my account, I want to get all my money out. But the remainder, right, what is not part of those required reserves is really how the bank makes their money. Because they take that money that's just been deposited and they'll invest it elsewhere in the market. And they primarily invest it, well, not primarily, they just invest it in interest-bearing assets. And the interest they earn is how they're actually making their money. Now, they do have to pay interest to their depositors, and this is what's known as a lending margin, where you have the difference between the interest that's earned and the interest paid. Think of it as like profit, right? Total revenue minus total cost. So those lending margins are where the bank's money that they earn actually comes from. So now that we've got that covered, time to get into bank runs. What is a bank run? Well, a bank run is when a large number of depositors try to withdraw all their money from the bank, like at the same time. Now, this is typically because for some reason, one way or another, they've lost faith in the bank's ability to be able to remain solvent in the future. So what happens is people go, oh God, this bank isn't looking too good, and I've got $100,000 in that bank. Oh boy, I could lose that $100,000 if this bank goes under. I'm going to go get my $100,000 right now. So you try to go and pull it out, and then, well, it's not a big deal if just you do it, right? If you're the only one that does it, no big deal. But let's say everybody goes, oh man, this bank's going to go under. Well, they all rush to the bank and they all try to withdraw their money. And because they all try to withdraw their money, the bank's not going to have enough cash on hand in order to be able to meet those demands. So what do? Well, they have to turn around and they have to sell a lot of their illiquid interest-bearing assets in order to be able to meet those demands. And they got to sell them fast, right? They got to sell them ASAP. And typically what happens is they have to sell them at a discount to be able to make that happen, right? Think about if you have a car and you need money like yesterday, right? Well, let's say you've got a $30,000 car, but you need money like right now. So what are you going to do? Well, you're going to sell that car. When you go sell that car, you may have to sell it at a discount in order to be able to sell it right now because you need the money now. You can't wait a couple of weeks in order for you to get like a good offer. So you may have to sell the car for like $10,000 even though it's worth $30 because you just need the money now. Well, if that happens, these banks have to sell all of their illiquid assets. Then they become insolvent because they've now sold everything they had for less than what it was worth just to be able to get it now. Now, the issue here with a bank run is that it can become a self-fulfilling prophecy. Right? The bank could be absolutely fine. The bank could be solvent. But for some reason, everybody gets spooked and they all want to withdraw, and they can end up collapsing the bank. So, as we'll get into a little bit later in this lecture, it could very easily be the case that the bank was fine and they got some false story, and they would still have an incentive to want to go and withdraw all of their money from the bank. Now, in order to understand bank runs, I'm going to cover a model on bank runs, and I'm going to cover it in the simplest possible way, so you don't really have to do any math or anything like that. Now, the model is going to show the problem of bank runs, and there are two parties. It's a game theoretical model, and there are two players in the game. There are depositors and there are banks, and there are 3 time periods for the model. There's yesterday, today, and tomorrow. So what happens is the depositors put money in the bank yesterday before learning that they need the money. So let's say they put $1,000 in, right? Now they can either withdraw today if they're impatient, or they can withdraw tomorrow if they are patient. And I made a big mistake here. I just noticed that. So those two need to be switched. Switch out the patient and impatient. Now there's a 50% probability that they are either patient or impatient. Now if they withdraw today, they get their deposit back, right? So they get that $1,000 back. If they withdraw tomorrow, they're going to get 1 plus R times $1,000 back. Why? Well, because there's the interest being paid, right? So it's beneficial to wait, but it's only beneficial to wait if you can wait. If you can't wait and you need the money now, right? Well, that extra, let's say 50, 60, 70, 100 bucks, right? That extra money isn't going to do you a lick of good because you need it now. So the more patient depositors will get more utility from waiting, and the impatient depositors will get more utility from withdrawing today. Now, when it comes to the bank has a short-term and a long-term investment opportunity. The short-term investment opportunity is basically locking their money in the vault, and it returns the exact amount that was invested. Doesn't really do much for them, right? Because you're just sitting on cash. It's idle cash. Now, the long-term investment, on the other hand, is where things get interesting, because this is where they will invest in illiquid assets, and it's only going to return a positive amount tomorrow, right? So think of like a certificate of deposit, right? You put some money in, and you can't really touch it for a while, and you just got to let it sit there. Now, whenever it matures, you get all that money back. That's awesome. But if, say, you're like, oh God, I need the money like right now, well, you can get the money back, but you got to take a huge loss on it. So if the bank needs to satisfy additional demands for these withdrawals, they've got to sell those illiquid assets, and they have to do it sooner than was expected. So it's going to return an amount less than what was invested. So if the bank invested $500 and they got to pull it out, they're going to end up getting a lot less than $500 back. Now, the depositor invested $1,000 and has a contract with the bank. Now, they can withdraw and get $1,000 back, or they can wait until tomorrow and get 1 plus R times $1,000 back. All right, so how does the bank meet the contract? Well, the bank can divide it into 2 parts. They can keep half as reserves, and they can take the other half and then invest it in their long-term investment opportunities. So let's say there's 10 depositors. Each one deposits $1,000. Well, the bank's going to take $5,000 and keep it as reserves, and then $5,000 and invest it. Now, why did they take $5,000? Well, the reason they took $5,000 here is, if you go back a couple of slides, you see there's a 50% probability that every single depositor is going to be the patient, and a 50% probability that they are going to be the impatient type. So what they do is they'll go, okay, well, it's 50-50 split. I'm going to keep half and invest half. But there's a problem for the bank, because what if you end up with a situation where more than 5 people want to withdraw? Let's say 7 people want to withdraw. Well, the bank has to sell their illiquid asset in order to be able to meet the additional $2,000 that's now required. So they have to sell off more than what they invested because remember, they're going to take a loss on selling early. Now, what value does the bank have to sell off to be able to meet these demands? Well, that really depends on the market. They may have to sell a little bit more, like, just a couple $100 more. They may have to sell like a few $1,000s more. It really depends on the state of the market. But the issue is, if they have to sell these additional assets before they're set to mature, they lose money. And that's not a good thing. Now, you might go, hey, what about deposit insurance? And I'll go, well, what about deposit insurance? What is it? Well, it's an insurance on deposits. But in all seriousness, it's guaranteed insurance on your deposits at a bank if the bank goes under. The FDIC is going to insure deposits up to $250,000, right? So if you ever go to the bank and you put your money in the bank, you generally see that little FDIC sticker, and it's going to insure your deposits up to $250,000. And what happens is it makes sure that you're not super screwed if the bank behaves badly. But then there's a problem. What if the bank does behave badly? Well, this is where you get a problem of moral hazard. And what is moral hazard? Well, moral hazard is when you have an incentive to increase your exposure to risk because you're not the one that has to bear the full cost of that risk, right? You're going to get less careful with your things if they're insured because you don't have to pay full price to have them replaced if you break them, right? Let's say you get a really, really nice, fancy new sports car. Now, let's say you can either have the option to insure it or not insure it. Under which scenario do you think you're going to be a little bit more likely to dog that sports car out and just floor it every chance you get? Probably the situation where it's insured. Why? Because you're engaging in more dangerous, I hate to say it, more reckless behavior, although, don't get me wrong, flooring, putting the pedal to the metal on a sports car is freaking awesome. But the thing is, you're going to be more likely to do that if you don't have to bear the full cost of any possible repairs should you crash the car. So is that a problem of moral hazard? Yes. Now, is there a problem of moral hazard in banking? Also, yes. What's the problem here? Well, take what we did with a car and then just switch that to investing with banking. If you have deposit insurance, you're more likely to make risky investments. The riskier the investment, the higher the interest rate you're going to get, right? As if we go back to the previous lecture from a few days ago, and we look at, the way this works is if there is additional perceived risk, then banks are going to charge a higher interest rate, right? Well, you got to pay more, but the beauty of that is they get more. So they'll make riskier investments. If there's no default, everybody wins. But by definition, it's a risky investment. There's a higher risk of default. And if it goes into default, well, the bank can go under, but you're not going to lose all of your money because your deposit is insured. Now, without insurance, the bank wouldn't make as many risky investments because they'd be like, we are 100% on the hook if anything goes on, right? Any funny business happens. So has this ever happened? The answer would be yes. It's happened a lot. It happened in the 1980s when a lot of savings and loans went bankrupt. What was happening was they were lending money out at 6% and they paid 3%. Which is totally fine until inflation shows up. Inflation eroded away those profits that they had. So what did they do? Well, they made riskier loans to try to make up for those losses. But that high risk didn't always pay off, and it ultimately ended up costing the taxpayers about $120 billion, which in the 1980s was a lot of money. I mean, it's a lot of money now, but it was even more back then. When else has this happened? Well, it happened in the financial crisis, or the events leading up to the financial crisis of 2007, 2008. Because banks underwrote loans with the expectation that someone else would bear that risk of default. Bad mortgages were written, and then they were sold off to someone else. Those mortgages were bundled up into securities and then sold off elsewhere. The bank writing the loan didn't have to bear the cost of default because somebody else did. Ultimately, what was happening was it was like you pulled the pin and you had a live grenade and then you handed it off to somebody else and then they handed it off to somebody else. Only you didn't realize it was a grenade. Maybe you thought you were playing hot potato and somebody decided to wrap a grenade in tinfoil instead of, potato. And then eventually the grenade goes off. There was no incentive to make sure that the borrowers could pay back their loans because the bank that wrote the mortgage wasn't going to be the one having to deal with the consequences of it. Now, you could also think of moral hazard here as a form of hidden action because, well, there are actions taking place that other people are unaware of. Now, there's also an issue here of adverse selection and that these bad mortgages were sold off to people who didn't know that they were bad. So there's also hidden information. So if you get into the moral hazard, adverse selection issues, moral hazard is hidden action, adverse selection is hidden information. Now, back to bank runs here for a little bit. Generally, only a few people are ever going to want to withdraw at any one point in time. But if a lot of people want to withdraw, well, the bank gets screwed. Because the bank runs short of liquidity and they have to sell their assets in order to meet those liquidity needs. And they may have to call in their loans early because the bank has also made loans, right? So they may have to call those loans in early. But the problem is businesses that borrowed that money would then have to repay those loans on the spot. They don't have it all on hand. I mean, if they did have it all on hand, they wouldn't have borrowed the money in the first place. They would have just financed it with the cash that they had. So production can get disrupted here, which can then cause further losses to the economy. And then, because this happened, the bank may declare bankruptcy, and then other businesses that the bank had financial obligations toward would possibly declare bankruptcy as well, and then it affects other creditors in the process, and things get really ugly. Now, bank runs can be caused by both real and fake concerns. So bank runs can totally be started by a 100% false story. If somebody starts a rumor that a bank can't meet its depositors' needs, people are going to rush to that bank to get their money out. And the bank has to sell their assets. And then ultimately it goes under. Just because there was a false story, there's a totally bullshit rumor going around. Now, depositors could know that the story is false and still have an incentive to withdraw. Why would they? Well, you may know it's false, but you don't know that everybody else doesn't know that it's false. So while you might go, bullshit story, everyone else panics, and because they're panicked, now all of a sudden you've got an incentive to withdraw your funds from that bank, and thus it becomes a self-fulfilling prophecy. If it happens to one bank, it's a bank run. But if it happens to a lot, it's what's known as a banking panic. Now, multiple banks can suffer these runs at the same time, and when they do, you get what's known as a cascading failure, where all or almost all of the banking capital in a country is wiped out as a result of this. Now, before you start to have a panic attack, there are tools that exist to prevent this from happening, such as deposit insurance. There's also the Federal Reserve as a lender of last resort. There are targeted debt relief programs to borrowers. There's also stress testing, which we've talked about in the previous lecture. And there are other forms of fiscal intervention as well. Now, this is going to wrap up the bank run stuff. So to conclude, a bank run is when everybody wants to withdraw their money and the bank can't accommodate all of those demands. And it can cause huge economic damages. So you have to have measures in place in some way, shape, or form in order to prevent bank runs. But you create a problem of moral hazard in the process because you're basically giving these banks an incentive to make riskier loans that they would not have made otherwise. Now that we've covered this stuff, we can finally get into Silicon Valley Bank and the somewhat moderate crisis or mild crisis that followed after. However, that is for next week. That is not for this lecture. So when it comes to this lecture, thank you for watching, and more will come in the near future.